Hi, Salim Omar here from Straight Talk CPAs. In this video, I'm going to share with you the most common deductions that you need to know about going into tax season this year. Now, you may have heard the standard deduction almost doubled than what it was in previous years. So that means you've got the option of doing the standard deduction or taking the itemized deduction, whichever one is higher. Many folks, millions of taxpayers are finding themselves doing the standard deduction because they get a bigger deduction compared to itemized deductions. For 2019, the standard deduction for a couple married filing a joint return is $24,400. For a single individual, it's $12,200. That's a pretty big tax deduction, and you only want to do the itemized if it's going to be higher than the standard deduction of $24,400 if you are married filing a joint tax return. Now, the good news is whether you can itemize your deductions or not, there are other deductions you can take other than the itemized deductions that can really put more money into your bank account. Let me go over what are called above the line deductions and below the line deductions. So we'll start off first with above the line deductions that most people are not that aware of. So the line we are talking about is the deductions that are above your adjusted gross income line on your tax return. So all the deductions above the gross income AGI, known as AGI, adjusted gross income, those are deductions and they reduce your adjusted gross income, making you eligible for certain tax credits and certain breaks that you wouldn't get if your AGI is higher. So these are really valuable deductions for you to take on your tax return. You know, the other thing to know about above the line deductions, all the deductions above your adjusted gross income line deductions are whether you itemize or not, you can take those deductions. So you can do a standard deduction if you're married filing jointly, $24,400, take that and still benefit from the above the line deductions. The first line above the line deduction is educator expenses. If you're a teacher, you can deduct $250. If you're single, you can deduct up to $500 of any educational supplies that you buy, and take that as a deduction on your tax return. The other deduction is an HSA, a health savings account. That's an above the line tax deduction. You can contribute up to $7,000 if you're married, $3,500 if you're single, into an HSA account. It's a health savings account that you use to pay for medical expenses. And the great thing is that you're able to take that as a deduction on your tax return. Now, if you're self-employed, you're required to pay self-employment tax, and you're paying self-employment tax to the extent of 15.3%, that's FICA and Medicare, of your net income. The good thing is that you can deduct half of that as an above the line deduction on your tax return. If you're contributing towards a retirement plan, a SAP plan, a simple plan, a 401k plan as a business owner, you're able to take that as a deduction as well on your tax return above the adjusted gross income line. So you get that as a deduction. If you're contributing money towards a SEP, you can do up to 25% or $56,000 as a deduction on your tax return as well. Self-employed health insurance deduction. If you've got a medical plan, you're paying health insurance premiums, you can take that as a deduction on the line item as well. Student loan interest, up to $2,500 that you pay for yourself or dependent, you can take that as a deduction as well. And then of course, IRA deductions, traditional IRA deductions, or a spousal IRA that comes in as a deduction. So you can see that there's a lot of room there in terms of reducing your tax bill by making those deductions above the AGI, above the line. Now let me talk to you about deductions that are part of the itemized deductions. First one, medical and dental expenses, to the extent that they're over 10% of your adjusted gross income. So if you've got medical and dental expenses of $15,000 and your adjusted gross income is $100,000, you would get a deduction of $5,000. $15,000 minus 10%, the threshold is 10% of your AGI. So 10% of $100,000 is $10,000. So 15,000 medical expenses minus 10,000, you get a $5,000 medical dental expense deduction. And there's a whole slew of things that come under the umbrella of medical and dental and vision and long-term care premiums, health insurance premiums, and so forth, that are all encompassed there. So medical and dental expenses is one deduction. Second deduction is your real estate taxes and state income taxes, that you receive that as a deduction, and that's what's called SALT. So SALT, and there's a cap of $10,000. So if you've got real estate taxes and state income taxes that come to $18,000, you'll be able to take $10,000 and get that as a deduction there. The other thing is mortgage interest. If you've got a home, you own a home, you've got mortgage on that home, you are able to deduct the mortgage interest for loans that are up to $750,000. Now there's a listing on the itemized deductions, which is other itemized deductions, and there's like 10 or 12 other deductions that you can get if you qualify for them. Example, casualty losses. If you've had any casualty losses, you can deduct those as well. So the itemized deductions consist of many deductions, and these are what I call under the line, under the AGR line. And if your itemized deductions exceed the standard deduction, then that is the route you will take. And when you do the math and they are under, if standard deduction is higher, then you would just go in, using that route and do the standard deduction. So we kind of quickly went through all the tax deductions that you need to know about as we get into filing season, and as you get your taxes, get ready to get your taxes prepared and electronically filed for the government. Thanks for watching this. Hope you found it useful.